Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager and education coach here at Schwab, and this is Advanced Charting Techniques. And today, we're talking about a topic that I'll admit I've kind of avoided for months and months, and maybe it's been some years that have dragged on. But this one's a little bit heavier topic, so I wanted to really gear myself up for a discussion of Elliott Wave Theory. It's a topic that gets requested from time to time. I'm going to try to make this one as direct or straightforward as possible. Should be a good discussion. I'd like to know how many of you out there are familiar with Elliott Wave Theory. It is one of those little bit, at least in my view, a little bit heavier lifting sort of an approach to technical analysis. Just chat in yes or no if you're familiar with Elliott Wave. But as you do that, let me say hello to everybody that's already chatting in out there in YouTube. Hi there, Agariba and Kevin, Joe, Chris B, Speak Truth. Truth will always prevail. Josh, David, Austin, Michael, Ricebird, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussions. This is a Friday webcast series that kicks off 1 o'clock Eastern time if you'd like to join the live audience here. I also want to let you know that my very good friend Connie Hill is going to be hanging out in the chats with that live audience. She's going to be answering any questions that I can't get to just during the natural flow of the presentation. Connie, thanks for having my back there. And Connie and I would like to issue an invitation to you. If you're not following us on X, please do. It's the best place to connect with your favorite presenters. That's in between these live streams, I should say. But you can find Connie there at Connie Hill CS. You can find me on X at Cameron May CS. All right, but let's get to it. First thing that we need to be aware of course, is the risk associated with investing. So bear these disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for the day. Just, and let me, as I do this, let me take a look over here to see what you've said about your familiarity with Elliott Wave Theory. Jesus says no. Ahmad says no. Steve, no. Josh, no. Marcus Hunt says Elliott, no. Scott says yes. Wayne says yes. That's what I suspected. So a few people familiar with this technical discipline known as Elliott Wave Theory. Most are not going to be terribly familiar with it. It is one that has lots of layers to it. So I've done my very best to summarize it in the most digestible way possible. So we're gonna tackle it today. So I'm going to give an introduction to who the gentleman was who created Elliott Wave Theory. This is a discipline that's been around for nearly 100 years now. We'll call it about 90 years. An approach to charting stocks and even market indices. So we'll get an introduction. We're gonna discuss the basic elements to Elliott Wave Theory, and then we're going to apply it to charts in multiple time frames, because one of the underlying assumptions of Elliott Wave Theory is that it's what we call fractal, or it can be applied to different charts. It should look basically the same whether we're using an hourly chart, a daily chart, a weekly chart, so on. So let's get right to it. The first chart we're going to use as our example is going to be Microsoft, but I did want to give some credit where credit is due. So Elliott Wave Theory goes back to the gentleman named Mr. Elliott. Specifically, his name was Ralph Nelson Elliott. To me, that always sounds like somebody that you'd maybe make an arrangement to go bowling with. Sounds like that kind of a guy, isn't it? Ralph Nelson. Anyway, sounds kind of like an old TV series character. Yeah, but he was an accountant and a chartist back in the day, and that actually stretches way back before charts were even available. So what Ralph Elliott did is he created a bunch of self-generated charts across a range of time frames, and he looked back over, and this is according to his own. It's just according to what he said for his research, right? But apparently he looked back over about a 75-year period, looking at self-created monthly, weekly, daily, hourly, and even 30-minute charts. And in studying those, he saw what he thought were repeated behaviors across those range of time frames, whether it was looking at a monthly chart or a daily chart or an hourly chart or a 30-minute chart, when specific behaviors showed themselves in the way that price moved, it seemed to give to him some insights into where it might move next. Now, obviously, that's sort of a description of what technical analysis in general is. It's a study of historical price and technical indicator behaviors to try to get some insight into what the future might hold. It's never a guarantee, right? But what he noticed was this fractal nature. Fractal, again, just meaning that if we look at it from way above or really up close, it looks basically the same. So regardless of time frame, he saw these behaviors in prices moving in what he called waves. And that's actually a term that we use commonly in technical analysis. The study of waves in price might hopefully allow a trader to recognize when a price is cresting and when it might be hitting a trough, highs and lows. This is really the basic underpinning of all of this. But let's just start our example using Microsoft and start to explore Elliott Wave Theory. Will says Elliott Wave Theory is really cool. Yeah, so if we start at its most basic, what shall I just call him Ralph? What Ralph noted is that stocks tend to move either up or down, described by Ralph as an impulse move or a corrective move. Impulse moves and corrective moves. All right? So using Microsoft here, you can kind of see these phases. Now, I could apply labels here. That might take a little extra time. We'll be using those terms frequently enough today. You'll probably get impulse driven into your head. You're probably going to get corrective driven into your head. But we have impulse moves are basically the up moves. Corrective moves are the down moves. And within those moves, within those waves, Ralph noticed smaller waves. And he noted at times he could break these down into repeatable patterns in those waves. So what he noted is as we move from one completed cycle of an impulse followed by a corrective move, so that would be one cycle, in other words, the low of one impulse to the beginning of another impulse move, the waves within the waves tended to move in 8 phases or waves, 8 subwaves. So let's talk about this impulse move first. And this typically consists of 5 subwaves. So we have wave number 1, wave number 2. Let's get that in there. Wave number 3. Wave number 4. And then wave number 5. I can just squeeze it in there. I know it's going to get kind of obscured a little bit, but you'll see we have 1, 2, 3, 4, 5. And all of these make up our, I'm going to go ahead and label it our impulse move. So as Ralph studied these waves, he noted that there may be repeated behaviors within those waves that help him correctly identify whether we're actually seeing a quote-unquote true impulse move or not. So he described basic characteristics of an impulse move. So according to Ralph, these are basic requirements in order to qualify an impulse move. Number 1 is it consists of 5 sub-waves. 1, 2, 3, 4, 5, as we've already labeled those. And of those 5 waves, we have 3 also called impulse waves and 2 corrective waves. Now finally, and not finally, but next, to qualify as a true impulse move, there are some specific requirements of the subwaves or the impulse waves themselves. number 1, number 3, number 4, number 2. These need to meet specific requirements. So number 1, or the first thing, is that this second wave, in other words, wave number 2, can't dip below the low of wave 1. Let's spell wave correctly. Let me give myself just a little bit more space there, so this will all fit right here. So let's talk about what that means. So the beginning of our big impulse move here starts with a run up in price, and then we get a pullback during this corrective move, number 2, wave number 2. Well, as wave number 2 pulls down, its low is not supposed to go below the low of the first impulse wave. I mean, if we're doing higher highs and higher lows, that would actually just be a lower low, which might put the trend under a big question mark. I think that just is sort of basic higher high and higher low analysis, but that is an explicit requirement for good old Ralph here. All right, requirement number 4 is that our third wave, so wave 3, cannot be the shortest wave. So wave 3 shouldn't be, and specifically, it shouldn't be the shortest impulse wave. So we have 3 impulse waves here, 1, 3, and there's our little 5 right there. Wave number 3 should not be the shortest. All right. And then a final requirement here. I said finally early. This is the final requirement. Wave 4 can't even touch wave 1. So in other words, this pullback, the corrective wave right here, wave number 4, its low should not come down and touch any portion of wave 1, or in other words, the low of wave 4 should be above the high of wave number 1. So if we have all of these elements in place, then according to Ralph, we've identified a true impulse move. Now, I will say I know a lot about Elliott Wave Theory, and if there's one thing I know about Elliott Wave practitioners or theorists is that they can be really, really nitpicky. This is a pretty precise discipline, and certainly there are other lists that you'll see regarding impulse moves that are more extensive than this one here. This might be what might be about the most basic description of an impulse move that you're going to encounter. Right? Art's asking a good question. Which wave do you trade? Oh, I might as well skip to that, Art, if we think that we've correctly identified a behavior in price, and if we think that we're entering into a new impulse move. For some traders, they may put their greatest emphasis on trading this wave number 3. As we get up here to wave number 4 and trying to capture wave number 5, since it could possibly be the shortest up move, and it might be the one closest to the top, this one might be the least tradable. Does that make sense? Yeah. So, as a matter of fact, that could apply right over here. Although, I will say, this little move right here, for some technicians, knowing what they know now, they might say, wait a second, maybe this doesn't qualify. All right, so there are our impulse move phases. Now, as we finish this impulse move phase, price might shift into a corrective move phase. And let's talk about that. Because according to Ralph, it had some requirements. Number 1 is that it consists of 3 subwaves, not 5. It's a shorter term move. Number 2, let's get a period in there instead of a comma. We have 2 still impulse and 1 corrective. But in this case, the impulse, to me, when I think of impulse, I think of something that's kind of forceful. I don't know. An impulse is what drives you to do something, right? In this case, in a corrective move, let's label this one. There we go. So we have our corrective move starting here. We have 3 waves. We have 1, 2, 3. Although these are typically labeled with letters instead of numbers. So our 5 subwaves on an impulse move are typically numbered. But Elliott Wave theorists will typically, to distinguish the impulse move from the corrective move, they will letter the corrective move. So instead of saying 1, 2, 3, 4, 5, maybe 6, 7, 8, or starting over at 1, 2, 3, instead it would be this: A, B, and C. Okay, got that? 1, 2, 3, 4, 5 in the impulse phase, A, B, C in the corrective phase. Now, with these corrective moves, we should see a lower high. Now, right here, Elliott Wave theorists are going to say, no, Cameron, you have to describe that a different way. What they would say is that the B wave should not rise above the top of the A wave. Well, guess what that means to me? That's a lower high. That's all that means. So yes, there could be different ways to describe that, but just as we move through that A, that this is an impulse downward, a corrective move against that corrective trend, here upward, that B wave should not exceed, the high of that should not exceed the high of the A wave. In other words, we see a lower high. Now, a final requirement of this corrective phase is that wave C can't be the shortest wave. All right, so our technicians here might say, I don't know about this one that you've labeled here, Cameron, and I would agree with that. Yep. Technically, this C phase, this C wave should have been a little bit longer. So can't fault any of you Elliott Wave theorists that are looking at this right now and saying, Cameron, this does not look like, okay, this looks like a correctly identified impulse move. This corrective move, our C wave was not long enough. Indy says, why would one use this instead of flag breakouts? Well, flag breakouts are a portion of a move, which can carry potential. What Elliott Wave theorists are trying to do is identify larger moves than that, and conceptually may be carrying greater potential. Now, what you're probably already noting is there some discretion in the identification of these patterns? Absolutely. An Elliott Wave theorist needs to be very comfortable with applying their own discretion to a chart. If they're not comfortable with that, it's going to be a tough haul to implement Elliott Wave theory in one's approach to trading. But now that we've examined the elements of a true Elliott wave, here's a completed Elliott wave. Is there another one right here? Let's explore it. Let's zoom in here and let's see. Do we have 1, 2, 3, 4, 5? Yes, it looks like we could make that argument. Do we have an A, B, C behavior right there? That's a possibility. So this one's at least a suspect for another Elliott wave behavior. Well, let's start to explore the elements here and see if we can qualify this. So we have at least the first basic pre-qualifier for an impulse move, 5 subwaves, 3 impulse, 2 corrective. For our corrective move, we have our 3 subwaves, 2 impulse and 1 corrective. Now, on this, does wave 2 come down below the low of wave 1? No, not even close. All right, so far so good. Wave 3 can't be the shortest. So in this case, it looks like wave 3, we went from a low down here of 365 up to a high up here of about, I'm going to call it 430, just to keep my math simple. About a $65 move. Uh-oh, how far did it move here? We went from 388 up to about 468. That's about an $80 move. This one would throw this into question as a true Elliott wave for the purists of Elliott wave theory. Finally, wave 4, did it touch wave 1? So here's wave 4 right there. pulling back. That's our corrective wave. Did it touch wave 1? Came close. Look at the low here. Let me draw this in. It's these sorts of minor distinctions that for true Elliott wave theorists, they really draw these finite or fine lines. So here's our fourth wave coming down. Did not get down to the high of wave number 1. So that's okay. So I would say pretty much this is an impulse move, although for the purists, they would say it either is or it is not. Let me just remove that drawing. And then as we move to the corrective phase, 3 subwaves, 2 impulse, 1 corrective, lower high, and wave C is actually, in this case, pretty definitively the longest. For checkout 2 says, isn't Elliott wave similar to MACD? Not really, although that's interesting. There is an oscillator that I'm going to be introducing a little bit later that's intended to be used in combination with Elliott wave. Not all Elliott wave practitioners use it, but yeah, there's actually one called the Elliott oscillator. And it kind of bears some similarities to the MACD. Yeah. All right, so Carol, you say you had a question about that. Is it really okay for wave 5 to touch wave 3, considering wave 3 can't? Yeah, you meant wave 4? Nope, can't touch it. Well, wave 4 touching wave 1 is the disqualifier. So I think that's a pretty fair introduction to Elliott wave theory. But what we've been doing here is we've been applying this exclusively on a daily chart. Now, a big principle of Elliott wave theory, according to Ralph, is that it's portable, it's fractal, portable from one time frame to another. So let's look at, and as a matter of fact, we could even look at something like this. It can even be fractal on the same chart. I wonder, do we have any examples of a wave within a wave right here? Well, looks like we have maybe an impulse wave starting here, down to there. Is this a higher low there? Looks like it is. We run up again and start to kind of squeeze sideways here, a little bit of a pullback right there. But I think for some technicians, they might call this a second wave, and then a third wave. Is the middle wave the shortest of the 3 impulse waves within this? Nope. So that's okay. Does wave 4 reach down here and touch wave 1 within this wave within a wave? Yeah, I think you can start to see the fractal nature of this. And could there be a case that within this corrective wave, is there even a 5-wave fractal right there? Boy, I think that case could be made. So yeah, there can be waves within waves, or we can just change our time frame. So let's go have a look at a different time frame. And as we do that, it gives me a natural stopping point. I want to call this out for the live audience attendees right now. There is a survey there in the chat window. Thank you, Connie, for reposting that. I appreciate that. But if you've never filled out one of our surveys, just do this. Click on that survey link right now. You can fill the survey out when we're done with our discussion, and you can give me some honest feedback. But I'll just tell you, it's a really short survey, 2 multiple choice questions. It has a comments box and a suggestion box. And if you take the time to fill it out, I'll take the time to read it. It's never a wasted effort. It's always appreciated. All right. So let's get back to maybe looking at this through a different lens. Let's go a little bit longer term. How about we look at, how about a stock we just looked at yesterday, PG. So in a different webcast series, I was looking at PG. Oh, you know what? One other thing I wanted to say. Pardon me. If you'll forgive me, I'm going to flip back here, back to our Microsoft example, because I want to see if you can pick up on some of the subtleties of this. Because some of you might be looking at this and saying, well, okay, it looks like we've hit the bottom of a recent corrective move. So is this possibly a 1, 2, 3, 4, and we're working on number 5 right there. Is this possibly at the beginning of another impulse move, or actually we could be well into it? There's a pretty clear disqualifier there in my eyes. Can anybody spot it right away? What I noted right away is that if we're thinking that this is wave number 4, 1, 2, 3, 4, it pretty clearly went well into wave number 1. So that would be nope, doesn't count. Soma, that's an interesting question, Soma. Soma says, can we incorporate fib tools into this? I was tempted to do that today. I thought that might be going a little bit deep because there's actually a strong case that this is all basically built around Fibonacci behaviors. But I think that might be going a little bit too far, and my objective here was to simplify this quite complicated technical approach. So, yeah, that's a great question. Kathy, yeah, you're also saying the third. Let me rephrase that, because Kathy, you say the third line has to be the longest. Not quite. The third long is only required to not be the shortest. That's not the same as the longest, because there are actually 3 of them. It's okay to be the middle length. It's okay for it to be the second shortest or the second longest. Not required to be the longest. It just can't be the shortest. All right, so now let's go back to PG. And I want to bring this up on a weekly chart. Let me make sure. Yep, that's what I thought. Maybe let's expand this out to a 10-year view. Let's click OK. So here we are. We've learned our theory on a different time frame, but there are technicians who would apply this to a longer term time frame. Of course, they might also be looking at a shorter term time frame, but I just want to look at this at a longer term. And here we have what ultimately appears to turn out to be a strong impulse wave in an impulse move. So here's our start to finish sort of impulse move. Let's draw a line here. Looks like it might go up from there to there, and then we have a corrective move right there. So here are waves within that move. Wave number 1, wave number 2, wave number 3, wave number 4, wave number 5. What did we just learn from our last chart that may be a disqualifier for this one? Wave number 4 kind of dips its little nose just below the high of wave number 1. And for some, they'd say, nope, that's a disqualifier. But we still persist up here to the top of the 5th wave. It looks like we might start into a downward corrective wave. 1, 2, 3. However, wave number 3 could certainly be longer. So, yep, these sorts of little distinctions is what we might learn. But I think we already have enough repetition with that. We don't need to beat that one to death too much. But for some still, just identifying, okay, they might say, Cameron, how did you know where to start this? How do you really know where to end this? It seems to be a lot of discretion. How do we know where the highs and the lows are within these cycles? Because aren't there some others that we could make a case for, like this being a low, or this being a low, or this being a low? Isn't there some way to make this a little bit more mechanical? And yes, for some, they do use a mechanical approach to the identification of these waves, or at least they look for a mechanical assistance to the identification of these waves. And it's through the incorporation of an oscillator known as the Elliott oscillator. So I'm going to bring that into our discussion here. Let's come up here to our Edit Studies icon, and I'm just going to type in ELL for Elliott oscillator. One thing I've noticed about the oscillator, I don't know why this happened, should have another T in there. So Ralph Nelson Elliott spells his name with 2 T's, but that's the correct Elliott oscillator, okay? So we're going to select that. Chris B says, so what do we conclude when we disqualify a wave that doesn't fit the pattern? So we look for a different starting point, or maybe we just look for a different stock? Yes, Chris. Yeah, a true Elliott Wave practitioner might just say, it doesn't fit my rules. I'm moving on to the next stock. That's it. Now, does that mean that our stock is untradeable? Could we just apply some flag patterns as someone else proposed earlier? Could we just look at highs and lows? Could we use moving averages? Could we use Bollinger Bands? Could we use some other technical approach? Yeah. But for someone who is trying to implement Elliott Wave Theory, it's kind of laid out as black and white. That's the way Ralph intended it. And for those who apply it, that'd be pretty typical. Yeah, just moving on. Okay, but let me just add this to my chart. I'm going to add the Elliott oscillator. And you'll notice here, as we add this, there's the number 5 and the number 35. And that actually is a pretty important insight into how this oscillator is built. Some oscillators, some technical indicators are comparatively complicated. Others, comparatively straightforward, at least in my assessment. This one made perfect sense to me the first time somebody described it to me. It basically takes a 5-day or a 5-period moving average. So we're on a weekly chart. So it'd be 5 weeks. And it takes a 35 period or a 35-week simple moving average. And it just looks at the distance between those two. So it's kind of like a simplified MACD. Somebody else asked, isn't this kind of similar to the MACD? Elliott Wave Theory is not inherently itself similar to the MACD. The Elliott oscillator bears a strong resemblance to the MACD. So let's click Apply and click OK. And I think you can see it even physically looks like the MACD. It's different though. The MACD is a moving average of the distance between two different moving averages, and they're even different moving averages than what we're using here. So it's similar, but not exactly the same. But our histograms here are simply the distance between the 5-period and the 35-period moving average, positive or negative, meaning is the 5 above the 35 or is it below the 35, and how far above or below is it? Valeron, you like this one? Good. I appreciate that, and I appreciate you filling out the survey. Definitely appreciate it. But for some traders, they'll use this oscillator to assist them in the identification of the starting points of a big Elliott wave, consisting of that, consisting of the up move and the down move, right? If we're looking at the full wave, the full cycle here, this indicator can sometimes identify where they're starting. So notice this. When we get a deep dive into red territory, for some technicians, they see that as a likely beginning point for a big wave. All right, there we go. So that's one of its potential values. It's interesting to me here that, yeah, our biggest moves on the Elliott oscillator, I think we could maybe make a case for 1, 2, 3, 4, 5. 1, 2, 3. Case could be made there. 1, 2, 3, 4, 5. And then 1, 2, 3. But another potential value here is to identify the lows within the impulse move. And those lows are commonly identified by looking again at shallower dips in our red line on our oscillator. So there are times when a trader might be looking at the chart and wondering to themselves, well, has our impulse wave ended yet? And have we gotten down to the bottom of the next corrective wave and started into a new impulse wave? So yeah, the lows of those impulse waves, the starts of those impulse waves are sometimes identified by shallower dips in our Elliott oscillator. The bigger dips may signal that an entire Elliott wave cycle has been completed. So that's an example on our weekly chart. I wonder if we were to go back to, let's go have a peek at Microsoft. And let's zoom in. We're on that weekly chart, so we kind of need to zoom in here. Actually, let's go to our daily chart since we use the daily chart there. I'll go to a 2-year daily. There we go. Click OK. And it looks like we have a deeper dip right here that started this wave. And we had a shallower dip right there, signaling the end of wave 2 into wave 3. And then we came down. It looks like we didn't quite get down to the red in this case. Didn't quite get there. So did it do it perfectly? Not exactly. But still, did it provide some assistance to the trader in identifying the beginning of one potential entire wave cycle. And maybe here's another one right there, or another one right here. And boy, do we have another one here? Look at this deep dive on our Elliott oscillator. We had the beginning of a wave there. Did we have another one here? Yep, right there. Look at that. So we have a deeper-ish dive right there, signaling the start of our next complete wave. We have a shallow dip there. There's one right there. Maybe a trader might have thought that could be the end of a wave. And as a matter of fact, we got a kind of a wave within a wave there. But in any case, a second right there, and then the beginning of the next big cycle here. All right, let's see. So for checkout too is saying we could look at a different technical indicator. I'm not going to go deeply into that. Williams fractals that look at the candles individually. Let's see what else is being commented here. I think that's it. Great. So that's going to leave us with a little bit of time. Maybe we can look at a couple of other examples. We're on a daily chart. Should we look to see if we can see some other examples here? Here's NVIDIA. Looking at that daily chart, we have a dive below the red line with our Elliott oscillator, signaling we could be starting into a new cycle. We have wave 1, 2, 3, 4, 5, and then 1 or ABC. Got a deep dive there again. That may be signaling that we're starting into a new cycle. So for a technician here, where might they feel they are if they're on this daily chart for NVIDIA? They might look at this. There's wave 1, wave 2. It looks like we might just be in the middle of wave 3 because we haven't had yet another Elliott oscillator red. So Kathy says, what does a shallow dip indicate again? A corrective wave? Well, Kathy, when it might signal the end of a corrective wave and the start of an impulse wave. So if we got a shallower dip here relative to the start of the next cycle, it might signal that we're just at the bottom of a corrective wave and starting the next impulse wave. Yeah, Chris, you say we might just be in wave 3? Yep, exactly. And then the trader might carry that knowledge forward. It could certainly inform how they plan to trade that stock for a little while. Well, if we're in the middle of wave 3, the trader might either say, well, I'm going to get in and see if the wave continues, or, our Elliott oscillator is looking maybe a little bit top heavy here. They might wait for a corrective wave and get in, maybe just try to capture the upside potential of a wave 5 if it manifests itself, if it shows up. All right, what's going on with Alphabet? I think we just had somebody ask about Alphabet. Actually, this one I don't want to clutter it up. It's actually part of an active trade that I have right now. I don't want to erase that, so my apologies. I'm not going to go into that one, do any drawings on it. Let's go have a look at a weekly chart and see what's going on with, let's say, Intuitive Surgical. With Intuitive Surgical, deep dip here on a weekly chart. Looks like we had, and actually, I might even need to go to a longer term chart. 5-year, let's switch this out to a 10-year. There we are. Yeah, so we started down here in the red with our Elliott oscillator, long phase 1. So there's wave 1, 2, 3, 4, 5. Each of these punctuated with a red shallower dip on our oscillator. This one's pretty shallow. It's because our price was, comparatively speaking, not moving dramatically back here. But this is more typical of what one might look to see on that corrective wave. We got a deep dive here on our oscillator, And then we started into possibly, how might we qualify this? This could be 1, 2, 3. 4 was a little bit too deep. It punctured number 1. Yeah, that might not be an Elliott wave. Even though we did have red here, we did have red there, so those were coincident with these lows. But everybody got some repetition with it. I always like to do that if we have the time. But we've tackled a big topic today. Now, as I mentioned, I'm sure that there's some of you out there that are kind of furiously typing in, hey, in my approach to Elliott Wave Theory, I like to incorporate, whatever else. It could be using Fibonacci's. Yes, there's certainly arguments that have been made for this being built primarily on Fibonacci's. So we could have discussed that. Also, some people say, I don't call it a motive move. I don't call it an impulse move. I call it a motive move. In Elliott Wave Theory, they're basically the same thing. Alaron says, do the numbers in this oscillator indicate anything like 1 ATR? No, it's just the distance between the 5 and the 35. All right, but everybody, we've introduced you to Ralph Nelson Elliott, given you a little bit of a history lesson. We've introduced you to how Elliott Wave Theory is constructed, how it might be implemented. We even detailed some of the basic rules governing Elliott Wave Theory's application, and we went through some repetition. So this is one, if we want to try to implement it, it requires some discretion, and it requires some practice. And even then, you put two Elliott Wave theorists on the same chart, and then they're likely to come to a different conclusion. So if you want to practice it, maybe go to your paper money, see if you can spot Elliott waves. See if you can fit those to the rules, and also maybe see if the Elliott oscillator is helpful in identifying the beginning and the end of the major cycles. Jay Richardson, you're certainly welcome. Alaron, absolutely my pleasure. Kathy, you're welcome. I always love doing these webcasts. I hope that you're putting it in your calendar to join me each Friday. This is what we do on Fridays. We talk about advanced charting techniques. Now, even though they're advanced, I try to make them as straightforward as I can, try to bring everybody along at a pace that everybody can follow. But thanks for giving me your time today. I have some other suggestions for you regarding educational resources outside of these webcasts. In between these webcasts, the best place to connect with your favorite presenters is on X. So if you're not following Connie and me on X, please do. You can find Connie here at Connie Hill CS. You can find me here at Cameron May CS. Now, another thing that you might want to do, I would strongly recommend it, and neither of these things cost any money, by the way. Following on X doesn't cost you anything. Subscribing to our Trader Talks channel on YouTube is another great thing to do, because this is where we post our previous archives organized into playlists. So you can find my whole series of advanced charting techniques right here under the playlist, for example. And of course, you can join our live streams here as well. So take a moment, if you haven't done it already, go down there and click on that subscribe button. Do us all a favor. And also thank you to everybody that's already clicked on the like button, the thumbs up. That's always appreciated. 156 people watching. To me, the fact that 59 people have already clicked the like button is a huge relief, because I came into this with some serious trepidation, as I mentioned. I kind of put off Elliott Wave Theory for a while, because is it a little bit complicated? Does it require a significant degree of interpretation, of discretion? Absolutely, yeah. So thanks for the likes. If you do like a webcast, please make a habit of clicking the like button every time, whether you're watching live, you're watching on the archive. That all helps. It's applause to the presenter. It also gives us a boost in the YouTube algorithm to get our webcasts out to a larger audience. Now, final request, it is survey time. Click on that survey link if you're in the live stream. Give me some honest feedback and I'll read through it. Thank you for doing that. All right, everybody, go enjoy your weekend. We have a few more webcasts coming up through the rest of the day. Watch those, then get on with your weekend. I'll see you next week. I'm going to look for you in future webcasts. I'll also look for you next. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.